So Rachel, single mother in her early 30s with a young child. Okay, she is self-employed and has a variable income, meaning that she doesn't make the same thing. You know, she doesn't make the same thing. Like it's not two fixed paychecks a month with the same exact amount. She could make variable. Okay, that could mean that she's could be doing different things, freelance work, waitress or anything like that. Okay. So that makes it difficult to plan for the future. And she's interested in the infinite banking infinite banking as a way to build wealth and provide financial security for herself and her child. All right. So I'm going to let Dwight start and I'll piggyback.
So the first thing is just going to be the variable income, which majority people that work in America have variable income. Even if you have a 9 to 5 and you get paid every 2 weeks, technically that's variable income because you're not making the same every month. Because when you get 26 paychecks in a year, there's 2 months out of the year where you get that third paycheck. Personally, when I work with somebody who kind of has like variable income, the first thing we kind of look at is kind of their budget. So we can figure out like what is kind of the average income they get so we can kind of figure out what they can afford from a policy standpoint. Because like we talked about multiple times in class, the worst thing you want to do is get a policy and then not be able to afford to keep that policy. So once we get through that, then we're going to start looking into more of a single mother wanting to have protection for her kid and things like that. So then we're going to look at setting up a policy for the child. But I would also suggest that we set up a policy for the mother and add the child on to that policy via a term.
All right. Excellent. So definitely, I agree with all of those because with hers, it's important to look at, even looking at maybe some of the flexibility of her policies, maybe such as the ability she might want to adjust premiums or take policy loans if needed. And maybe the possibility of adding a disability income rider or other features that would provide some additional financial protection since she does have her child. And in the event, that happens. So that could possibly be some other things to think of for her. But definitely that budget is key because when you don't make the same thing each paycheck, each month, or like it's just different, right? Because I'm an educator, so it doesn't matter. I get paid twice out of every single month. I don't care how many weeks are in there. I only get paid twice, and it's the same thing spread out over 12 months. So not everybody doesn't have that situation. So, which is difficult. So you do have to plan more and budget. Leslie says, can you explain how you add a child on a rider?
Yeah, so there's 2 different types of riders you can add for like family. So you can add like a family rider where like basically you have a primary person who owns the initial policy, and then you can add on a child, you can add on a spouse, you can add on multiple people via either like a family rider or a child rider. And what it does is because you already have a policy, it attaches them to your policy, but you are the primary and they become like secondary policies under your primary policy. And normally the pricing and everything is a little cheaper to add it on to that because it's kind of like bundling the policies together opposed to going out and getting like 3 or 4 separate policies.
All right. Leslie, you good? All right. I think that answered it. But again, we will have more questions at the end. So if you have additional questions to follow up on that, definitely get us when that time comes. All right. So we're going to talk about Michael. Michael is a young professional in his mid-20s who has just started his career, has student loans to pay off and looking for a way to build wealth and generate tax-free income over time. He is interested in infinite banking as a way to achieve these goals. So one thing that I said was Michael's age and financial situation when determining an appropriate premium amount for his policy, that should definitely be looked at because he's young. So that's, just the importance of him starting early and just being consistent with funding his policy over time will help him to maximize, for his potential for growth, right? And maybe you consider any riders, that would be beneficial for him, such as maybe a term conversion rider that would allow him to convert his, term insurance into a permanent policy at a later date if he were to, have that particular insurance. So those are some things I thought about for Michael. What else would you add to like?
So there was a few of us in this group because I was in this one. I could actually relate to Michael. I'm in my late 20s. I have student loans, whether or not they get paid off. Honestly, like with compounding, I think most people can relate to kind of with savings or investing. The earlier you do it, the longer or the better off your return is. So like if you wait, for example, if you're in your 20s and you wait till your 30s to start investing or to start doing infinite banking or different things like that, there's a significant difference in the return you have in the end. So one, I would kind of be, happy for Michael for starting at an early age and kind of setting that, let's say for his future family and, maybe being the first person in his family to do it too and changing the trend of his whole bloodline will be kind of a big thing. But then to kind of get back to the policy that I would look at, because he's so young, definitely getting into an IUL to take advantage of the higher return. And then locking in some of the other things we might look at depending on kind of what Michael's health is and things like that. Maybe since he's young and he's getting in at a lower rate, it might be good to try to lock in like insured guaranteed, basically. So let's say maybe in his 30s or 40s, Michael has a health condition, but because we have that rider, Michael doesn't have to prove that he is insurable. He can just get a new policy. So different things like that to think of more of kind of a long-term play since he's getting it so young and how he can kind of keep it through his 60s, 70s, 80s and beyond. So.
All right. Good. So awesome. All right. Our last scenario is Lisa and nobody was. All right. What's up with that? Lisa is a 36-year-old woman who has some health issues in the past, and has difficulty qualifying for a traditional permanent life insurance policy. Because I know we had some of those examples coming up over the last few weeks. We had some people talking about those. She's interested in using infinite banking as a way to build wealth and generate tax-free income over time, but is unsure if she will be able to qualify for a policy. So what I thought about for this one is that she probably definitely wants to think about I thought about the IUL only because that one is known for using for retirement income. So that's the part that I thought about for her. But when determining if she can qualify for a policy, and what, she needs to think about what type of, policy might be appropriate for her. She might want to consider the potential benefits, maybe using a guaranteed insurability rider or a term conversion rider that would allow her to convert her term insurance to a permanent policy in the future. Because if hopefully that will be the insurance that she has, since she hasn't been able to qualify for some assurances that she has some type of insurance, right? And maybe just looking at the importance of regularly reviewing and adjusting her policy as her health, and financial situation change over time.